Early November is normally a time for the focus to be on equine speculation and also Reserve Bank decisions. But this year, while the Cup was a thrilling finish, the RBA decision was a non-event, with no change in our interest rates expected nor delivered. And instead, the surprises are coming from the United States, with the US presidential election looking like a cliffhanger. This will have an impact on the US markets and the long-awaited December US rate rise, but also on global markets and international trade. So while a Clinton victory would settle markets down, we need to be across exactly what a Trump win might imply. Firstly, stock markets are unlikely to take this outcome well. The US and our stock markets, as you can see here, have been under pressure over the last few weeks, and much of this is attributed to the Trump ticket gaining ground. Secondly, the December rate hike in the US, while remaining our suggested outcome, would be far less likely should Donald Trump become the new president, as the Federal Reserve has been quite upfront that it is trying to minimise market volatility, and a Trump win would no doubt add massive volatility to financial markets, even though the impact on economic data and US corporate profits would take time to emerge. Thirdly, we expect a Trump win would risk a sharply weaker US dollar, and recent movements in the dollar against the yen and the Mexican peso are evidence of this. So for Australia, we expect a Clinton win to initially push the Aussie lower as the greenback strengthens, but a Trump win should do the reverse, and with amplified volatility. The other key impact locally will be driven by the fallout for free trade agreements. Both candidates have protectionist policies, but Trump is particularly critical of China and the Trans-Pacific Partnership. So with China our largest trade partner, clearly demonstrated in this chart, showing exports by destination, this will all be crucial. Talk of an alternate trade agreement led by China, the Regional Comprehensive Economic Partnership, has been growing, and this may be our fallback position. The latest stronger data out of China is a reminder that our prosperity is less linked to the US and more to Asia, as long as commodity prices hold their nerve. And finally, back home away from US politics, the main news has been low inflation figures, reasonable foreign trade data, but still concerns about our housing sector. So while the market has backed away from further RBA rate cuts, there is still the niggling fear that the large supply of apartments and high-rise housing in the next year may be exposed as a weakness for our broader economy. More on that and the Reserve Bank's latest thoughts from today's statement on monetary policy in the next market update from Bendigo Bank.